Equity management. A treasury professional may need to be involved in equity financings. This could include a private placement, an IPO, or follow-on equity raises. Taking on more shareholders, particularly public shareholders, creates more onerous financial reporting requirements and oversight for a company. Private placement. A private placement, or more technically known as a Rule 144A equity offering, is an unregistered offer and sale of equity securities issued by a U.S. or foreign company, the equity securities of which are neither listed on a U.S. securities exchange nor quoted on a U.S. automated interdealer quotation system. Privately held companies may find a Rule 144A equity offering to be an attractive alternative to an IPO, especially if the IPO market is closed. The market often views an equity 144A offering as a stepping stone to an IPO. IPO. An initial public offering, IPO, is the first time that the stock of a private company is offered to the public. IPOs are often issued by smaller, younger companies seeking capital to expand, but they can also be done by large, privately owned companies looking to become publicly traded. In an IPO, the issuer obtains the assistance of an underwriting firm, which helps determine what type of security to issue, the best offering price, the amount of shares to be issued, and the time to bring it to market. Follow-on equity raises. A follow-on offering is an issue of stock that comes after a company has already issued an initial public offering, IPO. A follow-on offering can be diluted, meaning that the new shares lower a company's earnings per share, EPS, or undiluted if the additional shares are preferred. A company looking to offer additional shares registers the offering with regulators, which includes a prospectus of the investment. A follow-on offering can be either dilutive or non-dilutive. A dilutive follow-on offering occurs when a company wants to raise additional funding in the public market. When this happens, the company issues more shares, but the value of the company remains the same, effectively increasing the size of the pie and therefore decreasing the per-share earnings. The money raised from a dilutive follow-on offering is usually allocated to pay down debt and change a company's capital structure. A non-dilutive follow-on offering arises when existing shares that are held privately, usually by company founders, board of directors, or pre-IPO investors, are subsequently sold on the open market. The cash proceeds go directly to the shareholder selling the shares and not to the company itself. Since no new shares are issued, the company's EPS remains unchanged.